Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He digs into the silver pit and tells us about the big surge in lumber. Mark Leibovit from vrtrader.com gives us his take on gold and silver, the U.S. dollar, and whether the stock markets will hit record highs. He also mentions what sectors are hot right now. WolfStreet.com publisher Wolf Richter reports from San Francisco. He takes a look at the used car market, whether mortgage defaults will become a problem, and how the countryside is looking attractive to big city folks. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can also find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Good to be with you, Jim.
Ross, exciting times in the silver pit?
Yeah, the precious metals had a pretty good swing this last 10 days or so. And, you know, when we were on with you last week, we talked about silver, and we have various ways of measuring extremes. And we've got our own oscillator that we work with, and it's got a medium, high, and then an absolute extreme level in terms of measurements. And silver was just at that absolute level as of a week ago, Thursday, Friday. Seen this on the charts just going back, what do we got, 5 previous times in 50 years, so it's an infrequent item. And just so as soon as you lose any momentum at all, and that happened on Monday morning, then it starts to give back a lot of the price movement. You know, and when we look at it, I mean, I always like to look for patterns. And the history doesn't always repeat itself exactly, but the behavior of the traders is such that, you know, we can recognize where we are at given points. So when the reversal started here on Monday, Tuesday, we were looking for a pullback to overlap the 20-day moving average around $24.75. You know, and this is down from just shy of $30. So, and that type of correction, historically, you can expect to have that within 2 to 3 business days. So here we were, ended up with 2 biggest days in silver that we've had in since the break way down into the March low on Monday and Tuesday of this week. That's the classic. Then the next normal thing is you have a retracement rally that bounces back 50% or more, and you know we had that by Thursday's close. We'd gone from just sub of $24, and we were just shy of 28 on the rally. And pattern-wise, we're in a position now where it's very typically here. We can look for this to turn into a trading range, and we should take 15 to 16 trading days. That'll take us right out to the 1st of September, probably thrashing around here. And by the 1st of September, we should be putting in an interim high and looking for another break to the downside. And optimally looking for that low to be into the mid part of September and maybe a final low as we get into October. So the big run that we've had from $12 and change is just in need of this big consolidation phase. If it's like 1979 and it's just the early stages of a big bull market, we should have a pretty good idea by the time we get to the end of this month. We'll just see how the consolidation is running and how deep it is. And we've got parameters to look for. The key here being that I want to see certain levels of overbought as far as the short-term oscillators are concerned, like a commodity channel index. And I want to see a kiss of the Bollinger Band. That Bollinger Band is showing high volatility. It's way up around the highs right now. And if we consolidate, that band's going to come down. And once we kiss it, and we're overbought, that's going to become actually a very nice short sale for the move into the early part of September. So that's what I've got in mind for silver. Should be just great for traders. There's probably, it was a great trade off the bottom this week and into the initial bounce. There's probably another couple of good trades as we push ourselves into the middle of September.
Has lumber been a big surprise?
Yes. Ever since the low there in March with every other market, lumber has just gone through the roof, quote unquote. We ended up with a $250 low, and as of this week, as of Friday, this thing has been up to $750, and we're getting the extreme reading once again in our oscillator, and in this case, it's only been seen once in the history of the lumber market. Together with that, you take a look at companies like Home Depot, up into extreme levels there. We've gone from $150 to $280 in the last 4 months, getting readings up here of exhaustion, probably ready for a good hard correction in that one. And I would, in general, market, is clearly overbought and ready for a correction. And particular areas, probably like housing right now, are top of the list.
Ross, anything else that really caught your eye this week?
I guess I keep looking at correlations, and as far as the equity market is concerned, and the lows that we put in around July the 30th. It doesn't matter whether it's the NASDAQ or the S&P or the Dow. Those levels are going to become really critical as we move forward. This is very much, when we look at the hourly charts coming off the bottom with all this inflow of cash from the Fed, what they've been doing to the system, it's just a level beyond what we saw coming out of the 09 low or the 02 low, or even the 1929 low through until April of 1930. Each one of those saw the Fed doing a lot to pump the markets. And the key that we want to watch for is that if this thing rolls over, that we're probably going to very, very quickly give back at least a third of what we had coming off that March low. So that's really high on my list. Wouldn't be at all surprised that we put our top in here as we get towards Labor Day.
Ross, thank you so much for the update.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Mark Leibovit next on This Week in Money.
Always consult your investment professional before making any investment decision.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was the #1 U.S. stock market timer in the January 2020 edition of Timer Digest. He's speaking to us from Arizona. Welcome back to This Week in Money, Mark.
Thanks for having me, Jim.
Mark, before we get going, can you tell us a bit about vrtrader.com? And do you still have a special offer for our listeners?
Sure, vrtrader.com. It's Leibovit VR newsletters, but the shortcut to get to the newsletter is the URL vrtrader.com. And it's a technical letter. We do a lot of trading. We do make some longer-term projections, but I come from a trading background. Trading could be, some trades we'll do on a one-day basis, intraday if we get some moves. Other times it'll be a couple of days or a couple of weeks or more. I rarely hold anything for any great length of time. This is not an investment letter, though. We have been noted for calling some major turns in markets, and overall, market calls and so forth, whether it's the precious metals or it's just the overall stock market. And we do pick some sectors that we like. For example, the last couple of years we've been talking about the solar stocks being, a new hot area, and that has worked out pretty well. So, and there's always comments like that and recommendations, but we generally don't sit and hold for any great period of time. The only exception is some cannabis names that we have in our Canna report letter. But anyway, if there is a discount, if you do go to the website, offered only to the House Street subscribers, which is 2020 half off, which is the promo code when you go to the order form and you're asked to enter a promo code. It's 2020 HALFOFF. Thank you for asking.
Mark, last week you gave your subscribers a sell on gold and silver stocks. Why did you put out a sell, and what do you see ahead for gold and silver stocks?
Well, it was a straight-up move, and again, backing up to my comment of being more trading-oriented, it sure looked like a top to me, a blow-off. I mean, we just ran through the record high of 1922 and measured in U.S. dollars and just kept on running, and everybody just jumped on board, panicked, and bought it all the way up, well above, I don't believe the high was around 2070 or somewhere up there. I don't have to check the exact number, but it sure looked like a pullback. And again, since then, we sold it, had a big break. We jumped back in for a trade on the long side, and then we sold again on a little bounce that came after that. And right now we're flat, and my overall plan is to try to get back in. And the question is, am I patient here? Because some of our cycle work says we should be patient for about another month or so. But this is a very volatile market. It could trade up, come all the way back down again, and then go up again after that. So I guess for those who are listening to the broadcast, I guess they want to know what my thoughts are overall. My overall thoughts are that we're probably not done with this gold and silver rally. How high we're going to go, I'm not really sure. I don't really try to project that. I just look at them day to day and see how much of a movement we're getting. I can start projecting numbers, and doesn't mean they're going to materialize. But I would say between now and year end or into the first quarter of next year, maybe even stretching that far, we should see momentum to the upside. So looking to buy breaks, trade them as they go up. And at some point, if we get another break lower than where we were here, I think it was like 1880 area in the gold, which think about it, that was a heck of a drop from like 2070 down to about 1880 in a couple days. That shook the bulls up a little bit. If we go below that level, then I'm going to get real interested about another trade to the long side, and that could very well happen. So that's sort of what we're watching it day to day. And suddenly, if I came in Monday morning, gold's up $200 an ounce, and it's into new highs, I guess I missed it, and I'd have to decide at that point, do I chase it or what? So I'll have to look at the numbers if it suddenly explodes on me and I don't have another entry point. This has nothing to do with having gold coins in the vault and stuff like that. I mean, I have a couple coins myself. I mean, I'm not saying you sell everything. I'm talking about, trading the gold stocks and trying to take a trading position in what is a very volatile and lucrative market.
As gold and silver stocks pull back, are we likely to see a rally in the U.S. dollar?
Well, that's what everybody is looking for, and it sort of panned out here a little bit. I don't know, I'm looking at my chart now. I mean, I wouldn't say that the $200 break we had in gold was accompanied by any major rally in the U.S. dollar. I mean, it popped a little bit, hardly anything on the charts, and so I'm not sure if the U.S. dollar has all the impact that everybody is saying. I mean, sure, if it rallies, I suppose it could have greater impact, and maybe that's what would drive gold lower later. But like I say, the little pop we had in the U.S. dollar here about 3-4 days ago really, and that was coincident with the sell-off in the gold, really was minor in terms of its intensity. So I'm scratching my head a little bit about why that's such an important ingredient. I think it could have been a function more that gold just got overbought, just people got too crazy, and it just blew off to the upside in a parabolic fashion, and the force of gravity came in, and as it usually does in stocks or markets that do straight up moves, and nothing more. And also I would point out that over the years, I try not to tie markets together. I look at each market independently. I look at the gold chart, I look at the dollar chart, and I don't say because this is doing this, therefore the other market has to do that. I found there are times where all these markets go together. They don't necessarily are on an inverse relationship, and you have to be careful about getting trapped into a theory and let that be the basis of your decision. So look at each chart, each market, and decide, is the dollar a buy here or not? Is the gold a buy or sell here or not? And using some technical analysis and sometimes some contrary opinion, most of the time you can figure it out, and that's sort of my opinion about that. So right now we're just watching each market separately, and I'm not going to wait to see whether a rally in the U.S. dollar is a trigger or not. I think you'll see it in the gold chart.
Is a rally in the U.S. dollar likely to see a pullback in the U.S. stock market?
You know, again, you're tying two markets together, which I really don't like to do. We've had a big pullback in the U.S. dollar, and the stock market has continued to go up. And you're saying if a rally in the market, does that mean stock market is going to go down? I guess based on the way again, I don't like tying markets together. I mean, when the market was rallying, I wasn't really paying attention to the dollar or gold. I was just looking at the individual markets. But yes, the dollar has been weak here since the big blow-off in March, and stock market has been positive. And there's an old saying that a weak dollar is good for business, particularly since so many international companies do business overseas, and a weak dollar is better for their revenues and so forth. So, for 20 or 30 years, that was sort of a rough rule of thumb. You like to see the dollar weaker than stronger. But I'm not going to bet that a rally in the dollar here is going to be the reason why we get a sell-off in the market. I think if we get a sell-off in the market, it's because of seasonal tendencies this time of year, where you tend to get a pullback. It is the summer. Congress adjourned, so to speak, temporarily, and there was no stimulus package created. You got the election coming up, and everybody's nervous about what that means for the stock market, up or down. More likely down if Democrats get in, but not necessarily down forever. I mean, we get bull and bear markets no matter who's in the White House. So at the bottom line for me is there are other reasons to be concerned about pullback in the stock market, not a rally in the dollar, and the tie-in between those two markets.
Do you think we're likely to see new all-time highs for the Dow and the S&P 500?
No question about it. No question we're going to see highs. The question is, does it happen before the election, after the election, early next year? Does it happen next week and surprise even myself, who I'm a little more cautious here, and we take off again? There's definitely higher projections. I think the S&P, in my work, which is around the 3,300 level, projects up to about 3,800, but I can't give you a timing on that. Again, it could explode from here on some event in the next 30 or 60 days before the election, or it could come, like, say, after. So there are some higher technical measurements, so I think there is more coming. Whether the NASDAQ has been the big leader, I presume that'll do well, though the S&P and Dow have to catch up a bit. The Russell 2000 and the total stock market index haven't made the same type of advance that we've seen in the NASDAQ. So maybe NASDAQ will underperform if the S&P and the Dow do better on the next move. But yes, the answer is yes. Overall positive, but I would try to wait for some weakness here in August, September, if following normal patterns. And saying that, Jim, we're trading all the time. I mean, today we bought a stock called Nikola, which is the company, as you may have heard, that has this new technology for trucks. So I don't know if it competes with Tesla or not. You know, we made like 4 or 5 points in it on a trade today just because it hit a technical number, and we jumped in and out. And there are a few other names that we added this morning that did well. Boeing, for example, rallied today in a sloppy market. So, you know, we're always buying and selling stuff, and I hardly really look at the what the overall market's doing. I do check it, but if I see a technical pattern or something moving in an individual stock, we'll trade it. And it's sort of funny because Boeing is a Dow stock, I believe it is, and yet the market did well today, yet the overall market was sort of sloppy. So that's the best response I could give you.
We'll have more from Mark Leibovit right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.V. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Mark Leibovit. Mark, is inflation by money printing already affecting the markets?
No question about it. They're printing it like crazy. It's in there, supporting the market, providing liquidity. Not only that, you've got the government bailing out Wall Street. I mean, wasn't it not too long ago that we saw Federal Reserve purchase some defunct bonds in Hertz Corporation, I believe. I mean, they're doing anything. The Japanese market has been supported by the government there, both buying individual stocks and ETFs. The Federal Reserve and the powers that be would try to play down that they've been investing. And even, I think, Bernanke, back in the financial crisis in 2007, 8, 9, I think he was buying a lot of garbage. I forgot some of the companies he was investing in. I used to write up, I shouldn't say garbage, actually some big companies that he invested in back then. They're sort of crazy. So the Fed's in there is buying the stock market. So this is only the printing of money that's driving prices higher. I mean, they're in there buying stocks and indexes, and they may not be disclosing everything they do, but we do have the plunge protection team. We do have the working group on financial markets. It's been around since 1988, and there's a lot of shenanigans in the background that's just not disclosed, and I'm sure is still occurring. And the last thing the powers that be want is the stock market going down. So it is definitely the wind at the back of the market.
Are the markets in this election cycle likely to perform as they have in previous election cycles?
I don't even know what previous election cycles did, to be honest with you. I mean, there's all these cycle work that says you tend to get, a little pullback before the election and then stuff after. Whether that's going to happen this time, I can't say. All I can say is the market will be nervous about the outcome before it happens, and the question is, what happens afterwards. So I would anticipate some nervousness ahead of the election, and then, we'll sort of go from there.
President Trump says if Joe Biden and the Democrats take power, the stock markets, economy, and tax breaks will be screwed. Your thoughts on that?
Absolutely. They will be screwed. Doesn't mean there won't be other places to make money in the market. There are going to be other sectors. There's going to be other interesting opportunities. So that's the question. How do we make money in the market in the event of a Biden victory? So there's going to be, alternate energies, for example. You can always short the market, and you might have to short some of the insurance companies if they want to get rid of, if they want to provide universal health care for everybody. Should be interesting stuff. There will be opportunities, but the overall market, I think, initially would sell off, but there will be sectors, is really what I'm trying to say. Cannabis stocks are already rallying, for example. There's some big names that are making new highs here, mostly U.S.-based cannabis names. We have several on our list. The Canadian names are really doing poorly, though they're trying to bottom. There's a bunch of U.S. names exploding here, some of 300%, reasonably priced stocks, $15, $20 stocks. I don't want to mention names. They're in our newsletter, but that's been benefiting, anticipating a Biden victory, for example. So, energy may or may not do well because they want to stop fracking. That may hurt some of the energy companies. So there may be some short sale plays out there in individual sectors as well. But we have to look for the ones that will benefit from his victory. But my overall feeling is, yes, the market should come down initially.
Your thoughts on buy and hold versus active trading?
Gee, that's a tough one. There's 1,000 ways to make money in this business. It seems like I made this comment with no disrespect to, long-term investors, but, there's a lot of quote-unquote, dumb money out there that is very smart, that just held stocks, like, for example, during this big sell-off in March or even during the financial crisis, and is very patient and just sat there, and over time they ended up making money. So I guess there's no clear answer is what I'm saying. You could buy and hold and do well if you have the patience to do it. I don't have the patience. I guess it's my own personality weakness or whatever. I tend to be more aggressive in the markets because of that volatility, and I don't like to see a profit turn to a loss. So for that reason, I'm more biased to the trading side. And a quick story here: when I was a floor trader for a short period of time years ago on the Chicago Board Options Exchange, the guys that I work with all traded for the day, took their profits, closed all positions out, went home for the night fresh, took their check, so to speak, from the clearing firm that night, and just disappeared. And their attitude was, this is a way of making a living. It's like a salary. You made your money for the day trading, come in the next day fresh, so you're not biased one way or another. And that also avoids any surprises in the morning where you might have a nice profit in something and suddenly it turns out to be a big loss when some news story suddenly comes out or the market suddenly unexpectedly collapses from some event. So I was sort of biased from that, thinking that this is a way of making a living, not a investment vehicle for me, because you can make a living doing it. You can avoid the risk by trying to keep from holding too many positions too long. And again, that flies in the face of the long-term investor who is very patient. So if you're a patient person, the powers that be, we've learned this over the last 100 years, prices do continue to move higher. We have big shakeouts as we had back in 2008-9. We just saw one now. We saw all kinds of corrections, but ultimately they have to inflate the prices and keep going higher. So if you're not too old and you have the patience, buy and hold is not a bad idea. Particularly if you're young, like my kids are in their 20s, and they do want to take a long-term view, let them put money away, just let it grow and don't trade it, and just depend on their occupation to make their their daily living, so to speak. So it depends on who you are and what you're looking for. Again, I have my own biases, but that's because of my background.
Mark, thank you so much for being on This Week in Money.
Thank you for having me, Jim.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He was speaking to us from Arizona. Coming up, Wolf Richter, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, Wolf.
Thanks for having me back, Jim.
Wolf, what's the latest on the used car and truck market?
Yeah, so this is really interesting. The used car and truck market depends on the wholesale market for a supply of vehicles. And, there's a lot of trade-ins happening in the used car market, but a big part of the supply comes from rental cars and lease turn-ins, and some of the older cars might be repos, and And so there are auctions around the country, around the United States, and normally there are between 100 and 115,000 vehicles that are run through the wholesale auctions every week. So that's on a weekly basis around the country, every week. And that's so used car dealers go to those and buy cars at the auction, and rental car companies and leasing companies and others are selling their vehicles through those auctions. And so that's one of the big sources of supply for the used vehicle market. And that part of the market totally collapsed in March and April during the lockdowns. And part of the reason was that it came from two sides. The buyers stopped showing up, so the dealers stopped going to the auctions. There were problems with the health issues involved. So and auctions tend to be, people tend to be pretty close together, so they have to figure out how to do this. They have online auctions, but they weren't really popular beforehand. So dealers stopped showing up, and sellers stopped selling. And so this whole thing just kind of collapsed and went down by over 80% in terms of volume by early April. And the whole supply chain of used vehicles sort of froze over. And there was, on the used car side, the used car dealers, they didn't have a lot of demand either. So they saw this crisis and they saw the demand dry up, and so they stopped going to the auction and tried to run down the inventories to survive the crisis, to not get stuck with a lot of vehicles on the lot when there's no volume. And then the stimulus checks started arriving in households in early April. And, for a single person, that's $1,200. For a couple, that would be $2,400. If they have kids, it's $500 for a child. So it could go on up there. And so for a couple, $2,400, that makes a great down payment for a car. And that's exactly what started to happen. And so suddenly there was a major increase from next to nothing. So there's a major increase in used vehicle demand on the retail side, but from very, very low levels. And the dealers weren't stocked anymore to deal with that. So they suddenly started surging back into the auctions and started buying stuff. And they all did this together, and so auction volume bounced off from this historic low of 18,000 vehicles in 1 week in early April. That just collapsed to almost nothing, to a level that was actually higher than before the crisis. So in 1 week in early June, it hit 114,000 vehicles run through the auction. And all this data is from J.D. Power, which tracks the auction volume. And so you have this supply shock on the retail side. So dealers stop buying, the auction business collapsed, and then dealers see the retail demand, and so they go out and buy these vehicles at the auction, and the prices surge, and they have come down very hard when the market froze over. But on the wholesale side, the wholesale prices for used vehicles hit a record in July, and it just spiked. And limited supply, lots of demand, and so now dealers bought these units that are likely overpriced, and they're having trouble selling them. And so now we see auction volumes taper back off, and they have now dropped again below the pre-crisis levels over the last few weeks. And in addition, we're now getting the Hertz cars. Hertz went bankruptcy. All its subsidiaries went bankrupt in the United States and in Canada. So these cars are going to run. Some of these cars, close to 200,000 cars, are going to be run through the auction until the end of the year. And there's some other rental car companies that are still trying to get the fleets down. So there'll be plenty of supply, and retail demand is still pretty low. So we have this kind of weird situation. And this is, I think this is the first time in my life I have seen a supply shock and a demand shock come together at the same time. And it causes peculiar things in the markets. And so we have seen this plunge, and then followed by a spike. And now we're kind of leveling off and it's sort of normalizing, but at a lower level. And so the used vehicle retail sales are normalizing, but at a lower level. The used vehicle wholesales are normalizing, but at a lower level. The prices that spiked in June, actually in May and June, and reached a record in July, they're starting to be backing off a little bit in the wholesale market. So this will take a few more weeks to balance out. But it was just amazing to see these gyrations in the used vehicle market. And the used vehicle market is very liquid. I mean, these auctions are everywhere. They're weekly. They're big. They're well organized. They've switched them to online platforms now during the lockdowns, and that seems to be working pretty well. People have gotten used to that. And so rental car companies, they're trying to time this so when the market froze and there was no demand, they stopped sending the vehicles to the auctions. Now they're starting to do that again. Now there's more demand for them. So everybody's trying to maintain, everybody on the selling side is trying to maintain a high price at the auctions. But the dealers obviously want a low price. They want to buy as low as possible so that they can make decent profit margins when they retail the units. And, there are price pressures and consumers are shopping wildly, so you can't just raise prices when your cost goes up. And, so they're kind of squeezed now between, the cost of the units that they purchased in May, June, and July, and at the retail prices that have edged up a little bit, but not enough. And, so going forward, I think we'll see that normalizing. Used cars are, even in a recession, they're usually doing pretty well. So I don't expect this market to get hit too hard. The new car side is still way off from its, pre-pandemic levels, but the used car side is starting to normalize even though at a slightly lower level. And, so when the Hertz cars are showing up and the other rental cars, I think there'll be some downward price pressures on the wholesale side. If dealers are lucky, they may be able to keep that and just widen the margins, but it could be that on the retail side, pricing pressures will force them to keep that up. And so this is, I think, how this will work out this year. Next year will be different. Next year, the rental car companies will no longer be forced to sell the excess inventories. They'll be going through that process this year. The rental car business has the airport rental business has essentially collapsed. It's down by 80% or something like that. And so they need to defleet. They need to get rid of their fleets. And they have huge fleets. There's a couple of million cars in the United States. So they need to shed some of those. And that's happening this year. Then next year, rental car companies with the demand down, they're not buying. They're not buying new vehicles right now. They really cut their way back. So next year, there'll be fewer vehicles coming out of the fleet as they're trying to keep what they have and see where the market is going. And so there'll be less supply going through the auctions into the used vehicle market and to dealers. And so I think there'll be some more pricing pressures coming at the market at the retail side next year. And it's just because there is not a lot of supply coming into the market, and this may drag into 2021 as well.
What's going to happen to all the cars from the bankrupt car rental firms?
Yeah, so there's two big ones that went bankrupt, Hertz and Advantage. Hertz being obviously the far bigger one, and Hertz has got a lot of brands, and they all were pulled into the bankruptcy. And so the latest heard in coming out of the bankruptcy court is that Hertz and the creditors have agreed for Hertz to sell close to 200,000 vehicles out of its fleet, and that must still leave Hertz with too many vehicles. But the Hertz owes its creditors a lot of money, and so this is a negotiation process that's now going on in bankruptcy court, and so over the next 5 months or so, we'll see those 200,000 cars go through the auction. We'll see the excess advantage units go through once the bankruptcy court approves that. Other rental cars have also started to cut their units budget. Avis, they're defleeting. Smaller rental companies are doing the same thing. Now that everybody at first expected there to be a V-shaped recovery in the air passenger traffic, and this hasn't happened. So air passenger traffic is still down something like 70-75% from where it was a year ago, and that's a major business for these rental car companies. And so all these airport outlets, they're living off of this airport traffic, and that's down by about 70-75% from a year ago. So, now we're in the 5th month of this. So it's not just 3 weeks or 4 weeks or 5 weeks. Now this is looking like a very slow process. Business travel may never fully come back. There's a lot of expectation now, even in the airline industry, that's over. The business travel boom is over. Companies will be a lot more judicious in sending people someplace. They'll try to do more via video conferencing, and will send people to other cities only when they really need to. And so that seems to be pretty much how companies are planning to do this. And rental car companies and airlines are needing to grapple with this. Business travel is a big lucrative segment for airlines as well as rental car companies. And that's just probably not coming back. And tourism is also way down, but that'll come back up gradually. And so rental car companies, they have they keep the units a year or two, sometimes a little longer. So it's not easy for them to suddenly shed their units. There's all kinds of issues involved in that. So it will be a slow process for them to sell those units, but they will defleet. They will cut their fleets down to where they can survive a business environment where the sales may be half of what they were before the crisis. And right now, the revenues are a lot less than half. They're way down, and so half meaning a pretty good recovery already. So these units will show up, and they will put a lot of pressure on pricing in the wholesale market for a little while. And so that'll happen this year mostly, maybe early next year. And then once it dries up, I think the pricing pressure will go the other way.
We'll have more with Wolf Richter when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Wolf Richter. Wolf, given that so many people have lost their jobs, when are we going to see the wave of delinquencies on credit cards and mortgages?
Yeah, we've been waiting for that. But what has happened is the government sent out hundreds of billions of dollars to consumers in various stimulus measures, including the stimulus checks and then the enhanced unemployment benefits. So that expired now, but that was $600 a week, US dollars. So that's $2,400 on a month on top of the regular unemployment benefits. And this money got spent. And it got spent in different ways. And obviously some people used it to pay rents and make mortgage payments and other things. And other people, they will spend this they spend it on down payments of cars, those kind of things. And then other people pay down their credit cards with it. And the reason why they do is because they don't have any money in their savings account anyway. They're like companies, they operate off a line of credit. So they when they have money, they pay down their credit cards. When they need money, they pay for it with the credit cards. And so they really don't have savings. There's this theme going around that half of Americans don't even have enough money in their savings or checkings account to pay for like a modest emergency expense of $500. And that's true. They don't have that in their savings or checking account maybe, but they have a credit card or many credit cards with some room left on them that they can charge those amounts to. And that's what's been happening. And so we suddenly had a major decline in credit card balances in the second quarter, and that was particularly sharp in April and May, and backed off a little bit in June, but it still declined in June. And to the extent of over $82 billion in total balances that declined. And that has never happened before in the last 20 years that we track this data. So there are declines seasonally in the first quarter, always, after the shopping season before Christmas. First quarter is hangover season, so people are grappling with their credit cards and they're starting to pay them down and dealing with that. So there's always a seasonal decline in January, in February, March of the first quarter, but it's not very big. And during the financial crisis, there were some declines in the second quarter, but they were relatively minor. And now we have this huge $80 billion drop in the second quarter, and it's an indication that people use the stimulus money in part to pay down their credit cards, but also, they're not traveling as much anymore, so they're driving, but they're not flying. They didn't go overseas, so they didn't charge these flights on their credit cards. Business travel is down, so you have a lot of money that runs through credit cards. That way, people get reimbursed, but until they get reimbursed, it's on their credit card. So you have some slacking off demand of credit, and then people are actually using the stimulus cash to pay it down. And then there are people who still can't make the payments, and so now companies have credit card companies have come up with these deferral programs where they come into an agreement with the borrower that they don't have to make payments because they're impacted by the virus. And these deferral programs are now widespread, not just credit cards, but they have now spread to auto loans. And with auto loans, it's a particular issue because their cars lose value as you go. And no matter what you do, so they're going to become worth less 6 months down the road, and they're collateral for these auto loans. And when you defer loan payments, the principal balance grows because the interest is added to the principal. It's not deferral, so not forgiveness. You still have to pay it, but it's added to the balance, and then there's more owed later. So if the finance company has to repossess the vehicle, the loan balance will be larger than it was before, and the vehicle will be worth less. So there will be bigger losses involved for the lender. And then, of course, in the mortgage arena, we have a large-scale forbearance program that is backed by the government. So mortgages that are guaranteed by the different government agencies that we have, like Fannie Mae and Freddie Mac and Ginnie Mae, and we call them. Then one of Ginnie Mae is a government agency, but Fannie Mae and Freddie Mac are government-sponsored enterprises that were supposed to be independent, but they're now really dependent on the government. And so they came out with rules for lenders what they have to do. And they, between them, between these government enterprises, they guarantee a big chunk of the mortgages out there. And so these forbearance programs that they have rolled out impact the majority of the mortgages. And they have given guidelines to lenders how to approach this. And the over 7% of all mortgages in the United States are now in forbearance, meaning borrowers don't have to make payments. Again, forbearance is not forgiveness. You still have to make the payments, and you have to make the interest payments, but for a while you don't have to make payments. And so there are a large number of mortgages that were already 30 days behind that are now in forbearance. And so they don't even count as delinquent because a forbearance agreement is a deal where the bank says, we came to a deal, and so this is no longer a delinquent mortgage. This is a performing mortgage, and lenders still accrue the interest, even though they're not getting paid any interest. They're accruing the interest as a performing mortgage would, and so it doesn't show up as any kind of loss. But they know they're sitting on a powder keg with these mortgages in forbearance, and we have seen the early delinquency rate spike. So the transition into delinquency last month spiked, and then to a historically high level. And then these mortgages were rolled into forbearance programs. And the same with student loans. We have $1.6 trillion in student loans in the United States that have been automatically rolled into forbearance programs. So they, at this point, they essentially can't default. So everything, and we call this extend and pretend. Yeah, we're going to defer it. We pretend there's no problem. Extend and pretend is an old strategy in lending, and normally regulators really frown upon it. Because it's a very risky strategy, and there are real limits to what you can do. But this is the phase we're now in. We're now in the extend and pretend phase, and we're kicking this huge can down the road as far as we can kick it down the road. These forbearance programs are ending. Some of them are ending right now, and some of them are ending later. The ones that are ending, we will see what they will do. I imagine that given the situation, if it gets bad enough, they'll be extended and further. So we're rolling these delinquencies that we would otherwise have into deferral programs that don't show up as delinquencies, and so we have a very bizarre situation where people stop making payments on the loans. They came to a deal with the banks, so the banks are not getting paid. The structured securities behind those. Most of these mortgages are rolled into mortgage-backed securities, as are credit cards and auto loans. And suddenly, these structured securities don't get the cash flow from the payments, and so that's a huge issue. And it just goes up the pipeline. And so we're in this phase of extend and pretend where we don't see the delinquencies, but people have stopped making payments, and they're spending this money. So it's not like they save this money so that they can make those payments down the road. They're spending it, and we see that in retail spending. Retail spending has been pretty strong in June and July. It recovered in July totally, so it's a very concerning situation because we can't really see what's going on because we have all these people that are not making payments and that would be considered in a delinquency status. But they're not delinquent because they're in a deferral program. And these deferral programs are temporary. They end. And then, what are they going to do then? Hopefully they'll get their jobs back and hopefully they can catch up. And some of them will be able to do that. But this is going to be a huge mess. And we have no plan as to how to get out of this other than to extend it further. You know, this was started without an exit strategy. And, so now, we're trying to figure out how we move forward with it. All these programs have deadlines and they expire, and at the expiration date, you would have this explosion of delinquencies. 30 days later, 60 days later, these people still can't make the payments, and so you would have this incredible sudden explosion of these balled up delinquencies, and so I imagine there'll be more extend and pretend, but this is an issue we have. I don't think we have a real solution to it, and it's a lot of times it's better to let the debt blow up and let consumers and companies declare bankruptcy and move on, and let the creditors take the losses. But that's not what we're doing right now. Right now, we're in this full-fledged extend and pretend phase, and we're pretending that everything is okay on the credit side, and and it's not.
Have people started going back to the office yet in the U.S.?
Yeah, so I live in San Francisco, and when you walk during what used to be rush hour, the financial district, it's eerie. I mean, it's if you do it every day, it's depressing. Work from home is in some cities, especially such as San Francisco and New York, but in other places too, has really taken off among these office workers. And and these office buildings are not necessarily conducive to avoiding contact with others. You have crowded elevators that you're on for a while. You have crowded open office spaces. They're badly ventilated. They're just not designed for a pandemic. And so companies have moved out the date when they will require their employees to come back. Google has now said it'll be at least July next year before the work from home phase is over. Other companies have made it more permanent, made it a permanent option for people to work from home. Other companies have encouraged their employees to think in those terms. And so when we look at the data, as a company that tracks this via the access systems to office buildings and offices, and New York City is still down close to 90% in terms of office occupancy, in terms of people showing up at the office. And at the top of the big cities, Dallas and Los Angeles, and they're still down about 70%. And so people are really not, this is 5 months into it, so people are still not going back to the office. And now we have these COVID outbreaks in Texas and in Florida, so office occupancy actually declined over the last few weeks, where people started staying at home again further. And when you look at the chart of this, there's been very, very little progress since April, and no progress since mid-June. And so the commercial real estate sector is really worried about this because eventually some people will go back to the office. I mean, clearly it's not going to stay that way. It will recover to some extent, but there's a lot of discussion now about how much office space companies really need. And so what if people only come back 1 or 2 days a week to the office, and the rest of the time they're not, or twice a month? And these are options that are now being thrown around. And looking at the data right now, I don't think there's going to be a huge improvement over the next 12 months in this. And so you have all these huge office buildings essentially empty. And, you walk around these downtowns and these business districts, and what used to be packed sidewalks are not sparsely populated. I mean, it is like some kind of nuclear event took place or something. I mean, it's really scary sometimes. And so the shifts of this, and people thought after a few weeks we'll be over this and people will go back to the office. And now, Google and others are thinking a year, and others are talking permanent. And so I think this will be one of the biggest shifts to come out of this is how commercial real estate, how office environments are dealing with this, how companies are dealing with this, and where people live and where people work. That will all change with that. Traffic patterns will change, commuting patterns will change, and this is mid-August, and office occupancy in San Francisco is still down 85% from pre-pandemic levels. And that's astounding. It's not like you're not allowed to go to the office, but it's companies that say don't show up, and employees that don't want to show up, and they're working from home. Well, some of the companies have closed, they went out of business, and so a lot of companies laid off people, so they're not working at all. This is going to be one of the astounding long-term effects, how we restructure where we work and where we live, and the industry surrounding these factors will have to deal with it. Now, the longer this pandemic goes on, the further the old normal moves out of reach. We won't be able to go back there. That's gone. And the longer this thing drags out, the further where we will be. So there'll be some kind of new normal, but I think in terms of office space and where people work and live, it will look very, very different.
Wolf, before we go, can you just tell us a little bit about the wolfstreet.com newsletter?
We're just dealing with finance, business, and money, and we're staying out of politics.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Wolf Richter. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@housestreet.com. Now stand by for company showcase updates from American Manganese President Larry Reaugh and Aben Resources CEO Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, how's the pilot recycling plant going?
Well, we've put a press release out that the parts that we've been waiting for patiently for the last couple of months have finally been received and installed, and the plant has started up. So we should have news on that next week, and so that's gratifying. Optimizing the plant, could save millions of dollars in revamps down the road for the commercial plant. So this is a great thing to happen. There's other things that could be optimized, but we'll know more about that as we move through the chute. Certainly we're putting more material through, and so that's a good thing, Jim. But getting away from the plant, which I'll report on more next week. The stock, the shares of AMY have been steadily creeping up, and they bumped up against 27 cents, closed there yesterday. That is a resistance point. It's been a resistance point for the last 2.5 years, but I feel that we'll break through that and go into new territory. And today is a bit of a down day, lots of rearranging of shares and short positions for the weekend. So that continues on. But it's like gold. I mean, gold went up to over $2,000 and went down to below 1,900, and everything, hits a point, corrects, goes back, may hit that point 2 or 3 more times, and then break through. So I'm still expecting gold to be a terrific barometer of the economy, and especially in the measurement of inflation. So I expect to see $2,500, $3,000 in the next 2 years. And it's an opportune time for us to spin out our gold assets and rare earth assets to our existing shareholders on a ratio to be determined. And that'll be determined by the courts in B.C. There's a lot of work that goes on into that. We're trying to push the timeline as fast as we can, but, there are other things that we have no control over that take more time. But I've had queries about, how long is this going to take? My best guess would be 2 to 3 months, or maybe even a little bit longer. But it's a great opportunity for existing shareholders and any new shareholders coming in that they would be beneficial owners of the gold company that would be spun out. And so that's got to be a very big positive for purchases of AMY and existing shareholders. I mean, gold is going through the roof. I've been checking out a few stocks that are up 3,
400%, and that we're trading down in the Netherlands early this year. So that's the big thrust of the future going forward, and I don't see that diminishing. And so I want our shareholders to enjoy the benefits of a gold market, and so we're working away at that to keep that going. There are other things that commodities in general have taken a bit of a hit, not much, and but I came across an article that was written by the indigenous people in Russia about Nornickel. Nornickel is the largest producer of nickel in the world, and they had pictures in there of devastated landscapes and everything else, and how this is polluting the indigenous areas, and reducing the fishing and hunting and everything else that goes on with it. So they're asking for the world for help, and specifically Elon Musk to not be purchasing any of Nornickel's product. And so nickel is certainly taken the limelight from everything, thanks to Elon. And we can certainly supply a lot of nickel with our recycling, almost as soon as we can get the plant up and going to down the road for much larger quantities. And it's nickel is one of the flavors of the month, and it's kind of like cobalt out of the Congo at the DRC. And now you've got nickel coming from Russia, where pollution is part of their business, and it's they're not doing anything to correct that. So it's going to tighten the supplies of both cobalt and nickel, and certainly benefit the nickel producers and recyclers of nickel going down the road. And so we're happy to see that that other groups are bringing to attention some of the infractions and environmental infractions that are taking place in the world, so that we can give them a solid product that is has absolutely no pollution involved with it at all. So that's another great thing with us. There's a lot to talk about. Trying to remember it off the top of my hat is a little bit cumbersome, but the product and the proceeding of the company is well in place. We're talking to people about financing, so we hope that something comes together out of that. We're talking about other things which I under NDA I can't mention, that would help with our distribution and everything else of product. There's a lot to be done, and you got to remember that the only one that's really talking about recycling in any manner that shows that what recycling can do, rather than putting out a release that we're building a recycling plant that we get 90% or 85% recoveries. You don't know if that includes the battery as a whole, but we're out there transparent about everything that we do, and we don't have a lot of other help in getting that established. But the thing is that recycling is now becoming one of the focal points of battery manufacturers, EV car manufacturers, storage battery manufacturers, everything. What happens to the battery when it reaches the end of life? Because all the good things that it's done are destroyed by the pollution that's involved in the current method of disposal. So we're happy campers. We're bumping up against our 27-cent range, and I'm confident that we'll break through that at some point, and then we'll be into new territory altogether. So I think that's something we can look forward to, and I wish everybody a very great weekend, and that kind of concludes a thumbnail sketch of what I wanted to talk about.
Larry, if people wanted more information about American Manganese, where can they go and where are you trading?
If they want more information, we have a transparent site, AmericanManganeseInc.com, and we have you can contact the company here at 778-574-4444. You can contact me at LREAUGH@AMYMN.com, or you can go to the symbols and purchase a stock at TSX Venture Exchange under AMY, and the U.S. Exchange under the symbol AMYZF, and Frankfurt Exchange under the symbol 2AM.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on August 14th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back to the show, Jim.
Thank you, Jim.
Your exploration this year taking a little bit of a different path than past years?
Well, yeah, we're starting with a field crew, confirming some areas up there closer to the north boundary zone, but some areas that are, we historically knew. There was some pretty good surface sampling there from a couple of years ago. We had the guys go in this year and reconfirm that and extend it as far as they could possibly do to date, and that's all worked out really well. There's some pretty good looking rock samples that they've come up with. I mean, the area was historically, if you go back a few years when we initially sampled it, it's straight to the west and a little south across the valley from the north boundary zone, which gave up some very high grade material. The surface sampling work that we've done has so far produced, as far as gold grades on rock outcrop, anywhere it goes from 10 to 43 gram gold, 29.2 to 46 gram silver, and some very high grade copper up to 4.6% copper in samples. And they've just confirmed all that, and that's an area on the west side of the Nelson Creek Fault, which is the bottom of the valley. And it's below a scree slope, which is fortunate for us. What they've been spending their time on is reconfirming all that, because underneath it, we drilled a hole from last year under the Nelson Creek, the creek itself, but through the Nelson Creek Fault, and ended in mineralization right below this. So, there's a pretty good correlation there. The bottom 19 meters of the hole ended up with, 1.2 gram gold, 2.4 silver, and, this is the grades in the core, and 0.3% copper. So that's something you don't see as you move south. It looks to us like it's associated to the kind of grades and the rock looked identical to the grades that we're getting out of the north boundary zone, which was the high grade zone. And if we've got these high grades on surface, there must be something. We're hoping there's something underneath. And that's how we found the north boundary zone. It was rock outcrop. High grades, drilled underneath it, and we got that. So we think that this is a possible extension of the north boundary zone, or at least a faulted section of it, slip fault. And it's just south of, maybe 300 meters south of the north boundary zone, but across the Nelson Creek Fault. So it's got us, cautiously optimistic. That's what we're looking for. And then also associated with that, on the west side going up the mountainside. There's quite a big geophysical anomaly that we never tested because of the scree. And this is, potentially in our minds could be a feeder system, because we've got high grade in this area and it's all associated to a potassic alteration. And as we moved south like last year, we got away from the potassic part of the alteration. And it was just the sericite quartz veining, but it was also, things changed into more of a polymetallic where there was also lead and silver, with the silver and zinc. So this is constraining itself more to these gold, silver, copper on a higher grade basis. And this is what we're hoping we're going to be able to find underneath it.
Jim, for people new to Aben Resources, what's the company all about?
Well, it's a junior gold exploration company. We're located up in the Golden Triangle of British Columbia. And this will be our fourth season. We've drilled over 20,000 meters so far. And, this year we're probably going to start off with, in another week or maybe a few days more than that, we'll have the rig mobilized and we'll be looking at 2,000 meters to start with. If we have success, we'll increase it just like we did the first year. You hit some high grade, you're not gonna stop.
Jim, is there anything else we should be aware of?
Well, yeah. As a matter of fact, there is. The pad builders should be there. Today is the day they're scheduled, and to get started on building pads for the drill. And they figure it'll be about a week, and we can get the drill mobilized. I'm thinking in about 1 week. So that's all really good news at this point.
For people who need information about the company, where can they go and where are you traded?
Traded on the Vancouver, sorry, that's showing my age, the TSX Venture Exchange, under the symbol ABN.V. And you can go to the website. It's ABNResources.com. It's a great website.
Jim, thank you so much for the update.
You bet. Thank you very much.
I've been speaking with Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on August 11th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.